Hello, I thought today we would get into a discussion on depreciation, and I wanted to begin by just kind of going over the basics of what that is, and we'll start kind of at a basic level. But if we buy an asset, we purchase an asset, and this is something that has an ongoing value. It's going to live in existence beyond a year, and it's going to provide us benefits beyond a year. Then we get into items that begin, and certainly if it has a certain dollar threshold, then we get into items that begin to be depreciable in nature. So if you think about this, if I buy supplies that I'm going to use in production, I'm going to use supplies as something that would be a part of what it is I make or produce. And therefore, that's going to be something that's going to get used up relatively quickly. I'm not going to have an ongoing use for supplies. If I have a product that I'm making that requires five different components, I'm not going to get ongoing benefits from those components. I'm going to produce what it is I produce and sell it and then go about my business. So for those types of expenses, they are truly expenses. When I buy or when I make a purchase of supplies, it's an expense. It's going to be something that's a business expense. It's going to be a part of what it is that I produce. Okay. But when I consider equipment, I consider the items that I use to produce these products, or if I consider my vehicles, or if I consider the physical plant that I operate in, this is something that's going to have an ongoing benefit. It's going to extend beyond a year at least, and in some cases multiple years. And so how we account for that is much different. So I want to give you a couple of examples, and I just want to show how you would benefit, or how you would book rather, a supply entry versus a asset entry. So looking at this, let's say, for instance, that I want to purchase supplies of $5,000. In this situation, I would anticipate reasonably that I'm going to use up those supplies in short order, definitely within an operating cycle or a year. And so looking at that, my entry initially is going to be, I'm going to have a debit to supplies. And just for simplicity, we're going to say that we're purchasing everything with cash. I'm going to have a credit to cash, both of which are assets. My asset supplies is increased by $5,000, and my cash is decreased by $5,000. So what's going to happen in this situation? Right now, I haven't recognized expense just yet. But let's say I get to the end of the month and I do a physical count of my inventory. I look at my supplies and I realize that this is my beginning balance. And I look at my physical count, and the physical count shows that I only have $1,200 in supplies at the end of the month. I take the difference, 5,000 minus 1,200, and I'm showing 3,800. That $3,800 is going to be an expense, because if I think about it, I began with 5,000. I have 1,200 on hand now. If I subtract what I began with versus what I'm ending with, assuming that I had no additional purchases, then what is physically on hand is what my actual amount is. And the difference between those two values is what I expense during the month. In other words, if I want to get back to a level of $5,000, or $5,000 worth of supplies rather, I've got to make another purchase of $3,800 in supplies to get me there. So to do this and to record this expense entry, I'm going to have a debit to supplies expense. Sure. Of 3,800, and then credit to supplies of 3,800. 3,800, not 300. Okay. If I was to look at that on a T account and go back to, let's say, we'll set it up for supplies, it's going to look like this. Again, I have my original purchase, 5,000. I make my entry, 3,800. And now my remaining normal balance in supplies, this is what I would show on my trial balance if I was doing this, is $1,200. Okay. Now, that was for supplies. We anticipate that's going to be used up in a year or operating cycle, whichever is shorter. if I consider a long-term asset, something that's got ongoing value, let's say, for instance, I purchase equipment. And let's again say we bought it with cash. Actually, let's get my entries up here. We got equipment, and we'll say $10,000 just for simplicity. And we bought it with cash, $10,000. And so in this case, right now, the time of purchase, I still have no change in the value of my assets. The composition has shifted from cash. I've got 10,000 less in cash, but I've got 10,000 more in equipment at this point in time. Now, I record equipment expense differently than how I record supplies, because this is something that's going to have an ongoing benefit. So let's say this piece of equipment has a 5-year life, okay? And so to do that, what I want to do is get the number of, I want to get a sense of how much this equipment is being devalued each month, and we're going to call that depreciation expense. And so in order to do that, I'm going to take my $10,000 balance, and I'm going to divide it by 5 years times 12 months, or 60. And that tells me that every month I'm recognizing, let's make this a dollar amount. Let's see here, get my formatting correct. Just make it even like that. Okay. So what I'm going to do each month is I'm going to have a debit to depreciation expense in the amount of $166.67, and my credit is going to be to accumulated depreciation for 166. Okay, so what's going to happen is, if I'm looking at my balance sheet, I'm going to leave this piece of equipment on the balance sheet at $10,000. I'm going to keep the historical cost of that asset on the balance sheet as it is for $10,000. This account right here, this accumulated depreciation, is what we call a contra asset. Accumulated depreciation sits directly below equipment on the balance sheet. So it sits in the asset section of the balance sheet. And so what happens is, at the end of 1 month, I have the historical cost, but then when I factor in how much accumulated depreciation has happened during the course of the month, if I net the two numbers, the true value of the asset after 1 month is $98.3333. Okay. And what I'm doing here is, every month, as I'm recognizing this accumulated depreciation building, I'm finding that the asset itself is becoming less and less valuable. And if you think about that, if you buy a new car, it's less valuable the minute you drive it off the lot. It's less valuable a year after you've been using it. It's less valuable even still 2 years after you use it. That's what we're showing here. So by doing this, I'm recognizing on an incremental basis each month how much expense I'm getting. So let's look at this. If I'm setting this up as a chart of accounts, or it's not chart of accounts, but it's T accounts, I've got equipment of $10,000, and that's it. I'm going to leave it there at $10,000. That's how much that purchase is. Then I'm going to have, which are these T accounts here, and this is going to be depreciation expense. And this is going to be accumulated depreciation equipment. Okay. So what's happening here is, for depreciation expense, I'm recognizing in month 1, 166.67. Okay. On accumulated depreciation, I'm recognizing the credit. Okay. Now, depreciation will get closed out, and we're going to learn about that, or these expenses rather get closed out at the end of each period. So this account is not going to build in the same way that this account is going to be building. Okay. So at the end of month 2, I will recognize another 166.67. And I need to grab my precedent here. to where I'm showing accumulated depreciation, and I've got that on the wrong side. Accumulated depreciation of $333.34, which again shows another further month's worth of devaluation of this long-term asset. But in the next month, I'm going to recognize another 166.67, and so on and so on. This will get closed out every month. So what we're going to find in later chapters is at the end of each month, you're going to see an offsetting entry for 166.67. In month 2, you're going to have another 166.67 that gets closed out, so on and so forth, because your expenses don't roll forward. However, this account over here continues to build and build and build until eventually we get to the end of 60 periods or 5 years. And when that happens, the balance in accumulated depreciation, that contra asset that has a balance that behaves like a liability, but really is sitting in the asset section, is going to be showing a credit of $10,000. When that happens, the historical cost of the asset is on the books at $10,000, but I'm now showing that I have used up the asset, okay? Now, you're going to also hear the term, when we're talking about depreciation, you're going to hear the term salvage value. Salvage value takes everything that we did up here. Let's say we had $10,000 piece of equipment for 5 years. And so 10,000, 5 years or 60 months. And let's say for salvage, I'm thinking that I can get $500 off of it. So what that means is if I have a $10,000 piece of equipment and I have completely devalued this equipment, it's gone through its 5-year useful life, I'm saying that at the end of that period, I can sell it somewhere for scrap for $500. If that is the case, then what I'm going to do is I build my depreciable base. I take the 10,000 minus salvage, and then I'm going to divide that by the number of periods, okay? And in the process of doing that, my accumulated depreciation and my depreciation expense each month is diminished a little bit, because remember over here at 10,000, it's 166.67. Now it's 158.33, because I'm recognizing on the front end that I can later sell this for something. That's what this represents. A piece of equipment may not always have a salvage value, but if that happens, this is the one step that you would add into the process that makes the calculation a little different. From here, I do the same thing I did over here. The equipment goes on at its historical cost. I recognize a monthly amount of 158.33. My accumulated depreciation builds each month by 158.33 until, again, in this situation, I would be down to $10,000 in accumulated equipment, historical cost. Accumulated depreciation would build to 9,500, because again, I'm thinking I'm going to get some type of resale value at the end of it. And then from there, it's devalued, I can sell it and then recognize it as income at that point in time. Again, we're just touching the basics right now, and we're starting really from square one, but I think that gives at least a bit of an overview as to what depreciation is. There are different methods. The one that I just showed you is straight line. That's probably the most, well, not probably, that is the most common. It's the simplest form of calculating depreciation. There are other methods you'll learn about in later courses, and we can even touch a little bit of this one that allow you to accelerate depreciation to recognize more on the front end. But that's another topic for another time. Thank you. Have a good day. Bye now.